Hi guys, welcome back. For those of you online, the 1 minute delay or so, we were watching a little trend line in the DAX to see if it was going to break one way or another, and it seems to have done, well, kind of neither. We've broken it slightly to the down and then slightly to the up. Trend we were talking about is this little one here. Oops. So broken out of this small range around 87s, and this trend that's come from the dip back to the old wedge this morning has now just broken, and it's just sitting around the trend. It doesn't seem to want to come off, it doesn't seem to want to go up. I think part of the reason that we are struggling here is because the fact that the S&P does not seem to want to go up away from the 80 to 85 area. Is very, very trapped there. We are now breaking down, it seems, a little bit. S&P is very trapped there. This most recent move up, the FTSE couldn't go with it, the S&P couldn't go with it. Euro stocks made a tick over its recent high. So I think that's perhaps why the DAX is now struggling. But nonetheless, we are up above 80s, we're up above this range that we created around the 80 area as well. So if we staying above 87s, potentially we could keep going higher. But yeah, that little trend break, it did give you a trade, but I was just saying to Ollie in here, you're playing for about 8 ticks on that trade in the middle of lunchtime. It's quite a tight little trade to be having a go at. Nonetheless though, it has worked. You would have had to sell 95s, see a little bit of pressure as it came back up to 99s, and then you have got your 87s target, so it has worked out quite nice. So nice little call there from Ollie. Trend break and a little counter move. And using the context of, like I say, the other markets not going with it, perhaps that's, that adds to the trade. And in fact, we're now breaking right back into this range. You've got to start thinking now in terms of, can we actually move all the way back down towards 69s, in fact. So that could be your next area. So nice spot. And did you sell it?
I've sold it now, yeah. I was long on the pop above, now I'm short.
There you go. Particularly if the S&P sort of shows a bit of weakness now, and falls out of its little range, because where the S&P's been trading, those of you online as well, S&P's been trading in this little area here, continually holding above 80 and 3/4, 81 and 1/4 area. That was the point that I felt we should actually try and start moving higher from. We've even broken this trend line, which on an hourly still looks a little bit more intact. And now we're struggling once again. So we struggled at this high volume area up here around 86s. If we do start breaking this down, then yeah, I think that's going to certainly help drag the DAX a bit lower. European equities do look a little bit less inclined to go up. They just don't seem to have too much energy to the upside in them. This move up has been very, very muted. So we shall see on that S&P. I'm still of the opinion that the S&P, if it stays above 81.5, is likely to then push on, and we'll get a move through yesterday's cash hours high and take those highs out, which come in around 02s, I think. No, sorry, 98s. I think, yeah, if we stay above here, I think S&P will go through 98 at some point today. Could end up being quite a surge higher if we do break that. So a very, very quick move. It really catches people out. Right, foreign exchange we're going to do this afternoon. Again, a bit like commodities, it's more at this point about just things that you need to be looking out for during trades. I don't think fundamentally we'll have a little bit of a chat about the main drivers of foreign exchange, and then it's about areas you want to look at, and also products that you actually will want to trade. So I think this is probably the one area that gets the most false information about it as well. So we'll try and debunk some of those myths. Yes, it is the most traded contract, and this is a phrase that I particularly dislike, or the most traded thing going. Yes, 5.1 trillion trades daily. This is predominantly in spot, outright forwards and FX swaps. We'll come on to what exactly all of those things are in a minute. But it's this 5.1 trillion that sort of is used as an attraction device of this is why you should trade foreign exchange. No one ever steps back and thinks to himself, well, so what? It's not really going to make any difference if you're trading £1, £2 a point when 5.1 trillion trades. It doesn't make your trade any bigger, and it doesn't make it any easier to trade. If nothing else, that much trade says to you that there's more and more people in this that are probably more and more professional than you. So I find that a little bit of an odd reason to necessarily trade something. Right, so in terms of order terminology and whether this has any impact on you or not, spot market is what you would call the cash market, so the equivalent of, in equities you have a cash market, which you say the S&P 500. The spot is direct trades that are then settled within 2 days' time. That's what the futures market is priced off. An outright forward is basically the same as a futures contract, but this is between two parties individually for a specific amount. Generally, this is done through some kind of broker, generally bank to bank, or it'll be a company wanting funding for something, so they'll arrange a forward contract. FX swaps, this is a spot and a forward. The idea being that I will engage in a spot transaction with you now with the promise that in 3 months' time I will pay you back at X amount. So it then becomes my risk as to the currency fluctuation from then on, because the fact you're guaranteeing that you'll get your money back at whatever price is agreed, likely something positive for you if I want the money. So either a slightly better rate or at least the same rate, I then take on the risk. That would then be my issue then to hedge that, and that's where the futures market comes in, to try and hedge that risk. There's no centralised exchange, so you don't really have a sort of cash market hours, if you will. However, you do have fixings throughout the day. So a bit like oil, you have the main fix is the London fix for currencies. That comes at 2 o'clock, not 2 o'clock, 4 o'clock. So that 10 minutes into the London fix can produce a little bit more volume, can produce a little bit more volatility. On a day-to-day basis, not really seeing that much. Month-end basis, you definitely see a distinct pickup in it. So keep your eyes on currency contracts between sort of 3:45 and 4 o'clock. If you're going to see something, a little bit of pickup in energy, that's when you're likely to see it. There's also no centralised exchange either. So all transactions are OTC, so done over the counter, or they're done by banks or on EBS, which is the exchange brokerage system. So it's sort of a semi-exchange, but not one that is entirely sort of coherent and related exactly to foreign exchange. And as I say, futures are all derivatives of the spot price. So what does all this mean? Basically, this 5.1 trillion is slightly irrelevant because actually you're only really looking at the spot. Most of this happens completely off exchange, and a lot of it won't necessarily be hedged with futures. It could just be two people who are quite happy to engage in a forward contract at that amount. For example, if I know that I've got earnings in dollars, I'll be quite happy to engage in a forward contract with you for 3 months, whereby I know I'm going to get, perhaps I need to borrow in pounds. I'll engage a forward contract in pounds, so I'll take the pounds and then promise you the dollars back in 3 months, knowing that I'm going to earn them yes, I do have a small risk on currency, but you're earning it incrementally, so the currency risk is slightly less. All right, what you need to know. The majority of currency futures that you're going to trade are all going to be on CME. They're all priced in dollars, so some of them will be inverse to everything you hear quoted. Main one is the yen. Usually you hear yen quoted at 112. On CME, it's all quoted against the dollar, so it'll be yen dollar. Therefore, it is currently trading at 0.97, something like that. In terms of main things that get traded here, euro, pound, dollar CAD a little bit, particularly on Canadian interest rate decisions, and yen. There's not a great deal else. Last year there was a little bit of a run into trading South African rand on the elections and on Zuma perhaps being kicked out, perhaps not. And then he sacked his finance minister as well, which I've got a chart of in a little bit. But generally they're the ones that people will trade intraday. Everything else is more news related. If you have a look at the rand, it is particularly thin. So you've got to be very, very, very sure of what the news is if you're going to trade it, because very little trades. So you'll have a bid offer spread of 10 ticks. You're going to have to pay the spread to get in. If you're wrong on the news, you're going to pay at least 10 to get out. Likely more, because everyone else is trying to get out at the same time. The other contract that did get traded a little bit last year was the peso. And that's coming back again with NAFTA comments that are coming out at the moment. So US walking away from NAFTA generally seem quite bad for the peso because it ruins their trade agreements. Likewise for the CAD as well. So CAD and peso for any of these NAFTA comments that are coming out at the moment. The other big one for peso was of course the US election, where Trump coming in was seen as bad news for Mexico. Safe haven currencies as well, that's one other thing that I wanted to point out. We already spoke about gold and using that as a sort of safe haven bet, which, sorry, I've just answered that question for you. Gold, Swissy and yen are generally the places to go. Dollar always becomes a bit of a safe haven because of a rush to buy treasuries in the event of some kind of economic collapse, some kind of major world event. You'll get a rush towards treasuries. Interestingly, the dollar appreciated when the US got its debt rating downgraded in 2011, because that was deemed as something that could potentially cause a bit of a global crisis. So what did everyone do? US debt's been downgraded, buy US debt. It's now less creditworthy, but everyone felt that the risk of that causing other things to go wrong meant they buy it, so you actually got demand for dollar on that. Ironic, but does just prove how strong the dollar is in terms of a safe haven and how much people always seem to want to own dollars as sort of a reserve currency. All right, so most active, as you can see, it's all about the dollar, so virtually everything you trade will always be dollar. In terms of most active pairs, euro dollar, dollar yen, and sterling against dollar. Dollar EMEs against emerging market basket, so that's not really a tradable future, but it's something that sees a lot of volume go through it. In terms of individual currencies as well, you've got the sort of major currencies: dollar, euro, yen, pound, Aussie, and CAD. Beyond that, it's then getting quite vague on things for people to trade. Even the Swissy doesn't trade a great deal. It's predominantly against the dollar that you'll see most Swissy traded, even though the big news a couple of years ago, everyone thought it was all in the euro. The probably more tradable move was the Swiss strengthening against the dollar as much as it was against anything else. one point on liquidity as well, which is another thing that is often quoted as a big reason to trade these markets. What you've got here is Euro Sterling, Euro GBP there, and Euro Dollar here. And in terms of liquidity, they look both pretty much the same. However, you look at actually what's traded down here in Euro Sterling, it trades hardly anything. And volume at this point of the day, this was 4 o'clock in the afternoon, traded 1,300 lots, whereas Euro Dollar had traded about 130,000. So another reason why you'll barely see people trading anything that is not against the dollar. So that's where to keep your focus. Main currencies, as I say, to watch the euro, watch the pound would be the most common ones to trade. They're the only two that I ever really have up. I will have a yen up just in case of news, but there's no way I'll trade yen. It's a bit. Yen seems to be the quickest to move on news comments, and so there's almost no point in trading the yen on a news comment, because if you're going to miss one market, you're probably going to miss the yen. So you can use it to help you, but there's very little reason to actually go for it. So just have a quick look at that. Still not moving. Going back to those 87, so quite nicely. So yeah, just a little point on liquidity. So you could trade Euro Sterling, but you're going to have to hit market every trade. Not a great deal actually goes on in it. Did I have any other point? That was the only other thing. You look at the euro crosses down here. Euro yen as well is something that's very well watched, but not something you can trade. So I've given you some of the codes for things like Euro Sterling, Euro Swissy on the product code sheet. Have a look at them if you want, but there's still not a great deal going on in them. All right, instrument type, and this is the point I was trying to make on that 5.1 billion. Spot is only 38, and come 2016, 33% of the whole currency market. Currency swaps, obviously very, very small part of it. They are basically the example I gave a little while ago. It's usually company to company swaps, whereby you will swap money now, knowing that you have cash flow, so you will pay back in a different currency, basically. But very, very small part of the market. These are the kind of things that may well get hedged and could cause a little bit of movement in foreign exchange markets. But the only bit that you're really looking at is the volume in the spot market. So you say 5.1 billion, it's a third, so actually you're looking more like 1.7 trillion is traded daily, as opposed to the much larger 5.1. That said, I do remember 2000 and being at uni, 2002, 3, 4, and it being a trillion. So we had pretty big growth in foreign exchange trading in recent years. Okay, let's go and look at a few charts, a few examples that way, rather than specific sort of fundamental stuff. What I've got here is I've got a sterling dollar chart and a euro sterling chart. Now, the reason I've got this, the point of looking at the two side by side, is the fact that effectively a euro pound chart is a spread between a euro dollar and a sterling dollar chart. So you can use them to deduce different things. One, you can use it to deduce strength in which currency, i.e. if you started seeing the pound fall here, but you also started seeing the pound rising against the euro there, you could probably have a reasonable assumption that this could be something to do with the dollar. as in you're getting dollar strength against the pound, you're getting slightly larger dollar strength against the euro, which is then pushing what effectively is the spread between the euro and sterling higher. So you're seeing, no, sorry, that's not right, because that would be euro strength. Sorry. You get basically it'd be euro strength there if you saw the euro breaking, the pound breaking lower. So you'd be able to deduce that actually it's not a dollar move as such, it's a euro move if you're getting the two breaking together. Equally, you can use the euro sterling chart as a reasonable gauge of whether, you're going to get some strength in the whether you're going to get a little bit of strength in the pound, in the sense that this is clearly an area where you get pound strength. Because it's euro pound chart, you're going to get pound strength as you reach these highs. So you then start seeing pound strength against the euro. You're also likely to then see a bit of pound strength against the dollar as well. So just so you can use one against another. You know, if you start seeing the euro sterling break, you could then have a reasonable guess that you may well see the pound sterling against the dollar break as well. So useful way of using the two charts one against another. It's just a way of assessing which market it is that's actually showing the strength. You know, if you start seeing the euro dollar rising, euro sterling rising, but you're not seeing the cable rise, then that's a pretty good indication this is an all euro strength move. All good, all makes sense. Cool. I don't think I explained that the best, but yeah, we've got there. And yeah, that was the sort of the post-Brexit pound. So you sort of got back down to a level which coincided quite nicely with previous levels in euro sterling as well. All right, main thing when you're trading currencies more than virtually anything else is monetary policy. Country to country fundamentals do make a bit of a difference, but monetary policy is the big one. Higher interest rates, I think we probably all know this, basically make savings better in that currency, so that brings a greater demand for that currency. Falling currency creates less demand for deposits in that currency, and that falling currency is often caused by loosening monetary policy. So if you drop interest rates in your country, people are not going to want your currency so much. The counter to that is a falling currency is likely to create inflation, which is then likely to raise interest rates, which moves the currency back up. So there's always generally a bit of a link to monetary policy. What you do get though is you do get carry trade occasionally, and this is something that happened particularly in the early part of the 2000s, where you got a carry trade against the yen, because at that point Japan had cut its interest rates significantly more than almost any other country. So what you would do, borrow yen, sell yen, buy dollar, earn your yield on US Treasuries of 5% or so in the early 2000s, and then pay back the yen. Nice and simple, and you've banked yourself 5% with virtually no risk. And if you can do that leveraged as well, you then can make a large percentage of your 5% as well without actually having to use any money yourself. So that is something that has been seen in the past, and this is something that still partly goes on, and that's why you get this yen risk type situation as well, that people will flood to the yen in terms of trying to get away from any risk. It's low yielding, it's a generally reasonably stable country as well. So there's a movement back into yen because yen was used as a funding currency traditionally. Whilst I use the example of you would borrow it and buy, say, treasuries, the funding would often be used to buy other risk assets as well. So as soon as something starts going wrong risk-wise, people would then sell those assets and repatriate their money back into yen, which is where you then get the yen strength in a risk situation. Right, inflation, and this is all to do with relativity, relative between countries. If everyone's inflation is going up together, it's not going to impact interest rates. It's if your inflation is greater than some other country, that's when it makes a bit more of an impact on your exchange rate. So if your inflation is generally higher, your exports are going to become less attractive because they're becoming more and more expensive in your country. And therefore, yeah, I've written that wrong. Exports become less attractive, basically. Demand for imports will increase because you've got more money, effectively, so you can go and buy more. But what this then serves to do is, because your exports are getting less and less attractive because they've increased in your native currency, it then brings your currency back down. So theoretically, inflation should be cancelled out by currency. However, what you can have the flip side of, which is the worst side of it, is exchange rate driven inflation. This way you end up with a weaker currency, so your buying power in other countries is diminished, which therefore makes everything you buy from another country more expensive. And so that means that everything you bring in becomes more expensive. Wages in your country don't grow because there's no reason that if I'm a manufacturer in here that I should pay anyone any more money, particularly when my costs are going through the roof from buying from outside. So this creates a bit of a problem generally in an economy, in the sense that you get more expensive goods and unaffordability, which then creates to potentially companies going bust, more layoffs, further unaffordability, and a further reduction in wages, which is something we are seeing in the UK a little bit at the moment. They're trying very hard to get around this, and it's still a focus of the Bank of England. They're worried about wage inflation, which is not keeping up with the inflation imported by Brexit. Depending upon your economy, it's going to have a bigger or lesser impact, which is why, in a sense, Germany is doing all right in the euro, because inflation in the eurozone is reasonably low. Therefore, export economies won't fare quite as badly. You get high inflation. Germany, being a very big exporting economy, is going to get damaged by that high inflation. Would they have high inflation if they came out of the euro? Maybe, maybe not. But I'd certainly think that the euro could well be helping them there. The relative cheapness of the euro perhaps isn't so much. I think they would like it a bit higher. So that's inflation, monetary policy. Both, like I say, they're the biggest factors. So in terms of trading, the big numbers, if you are trading currencies, are the CPI numbers. UK CPI has been a reasonably big thing recently. Also, UK unemployment numbers that have a wage component to them as well. You get average hourly earnings from UK. That is quite a big impact. So irrelevant of the employment rate, it's the earnings factor that is what's driving the pound on some of these moves. Right, just a couple of little examples of monetary policy impact on the euro, and in this case this was a sort of double whammy situation, whereby what you got is the ECB signals a change to their QE program. So basically they said at this meeting that we'll consider expanding the QE program. Basically, you get a drop in the euro. You then, following that drop, get the Fed basically saying we're going to hike rates in December. So you then get a continuation of this move, and this, as much as anything from a technical point of view anyway, what you end up with is this downward sloping wedge at the low in euro sterling. Now, what you've got to question yourself, or what you've got to question the move, euro dollar has done 7 points to the downside on the basis that ECB may well change their QE program and the Fed may well hike rates. What happened in December was the Fed hiked rates and the ECB did a minimal change to QE program. So yes, both hawkish. Yes, neither of them were fully expected when they were done. They were pretty much expected, but not entirely. So you got a question, how much further down can this go? And that's why you got the complete opposite reaction and a massive rally on the ECB expanding their assets, but not actually doing any more. So basically they just expanded the duration of their asset purchases. They didn't do more. So despite the fact that they didn't do as much as promised, or well, they did less than promised, which is marginally hawkish, you got a very, very large move still, despite the fact that that was entirely expected. And the reason for that is this positioning here for the month coming into it. You just got this very slow, monotonous grind lower. There was no real notable pullback or sort of flow to this move. So what's happening is people are getting shorter and shorter and shorter at lower and lower prices, unless they got something very, very big, i.e. the ECB did nothing at all. They're not really going to get paid. There's no one who's going to come in and then sell it any further on the ECB doing nothing. So even if the ECB did completely nothing, there would still be a limited reaction to the downside. Even if the ECB actually did much, much more, i.e. greater weakness for the euro, there would still not be too much more reaction to the downside, because of the fact that it's already done the majority of the move. Because that's why you then get this very, very quick rush back up, takes out all of these previous highs in one day, and that move is around about 500 ticks on that reaction, just purely to the ECB not doing anything more than was expected. All right, so quick look at monetary policy again in how it's released and the impact it has. And this is sort of a forward-looking monetary policy. Something we'll be looking at tomorrow for the Bank of England, in fact, and this was a previous Bank of England. This was September's Bank of England last year. Basically, what Bank of England said was that most MPC members, Monetary Policy Committee members, judge a withdrawal of stimulus likely over the coming months. So that's enough straight away to start thinking, right, they're going to pull back on any of their stimulus, and you get straight away buying in the pound. This is building in an expectation potentially of a rate hike, an expectation potentially of a withdrawal of QE, and so you get this very, very fast move higher. This move in the pound round about 200 ticks to the upside, and then we get a grind on. This on a 1 minute chart as well, by the way. So that whole first move is around about 120 ticks to the upside. We then get a grind on and then continuation throughout the afternoon and the rest of it. Well, this is the next day. The other point to go with this, which really started helping continue the move, members judged that policy could need to be tightened faster than the market expects. It's basically saying the market needs to reprice what they're up to. And so you've got this very, very strong move in the pound. Taking us right the way up towards 136, and we're now still higher than that. We're now right the way up towards, well, 139 at the moment. So after this very quick surge up in September, we did get a bit of a pullback, and then we've continued. They then went on and hiked rates in November. So they gave you the clue, they gave you the pre-warning. Come the hike in November, you didn't get quite such a dramatic move because it was already priced in. Right. This is the imported inflation chart. So this is basically how Brexit caused a great deal of inflation in the UK. Brexit happens June 2016, so mid-quarter, so just around about here. It's only after a little while that the drop in the pound really starts actually taking impact. It's got, you've got to have a little bit of time before people's orders actually then start going through. And so you get a slight lag in the inflation pickup, but you do get the inflation really starting to pick up by Q4 2016. So that's just down here. That's actually just as the pound had its sort of final flurry to the downside. One last push down and then starts to bounce, but at that point the weakness in the pound then starts to really show up in inflation, and you get a move in inflation from around about mid 1% right the way up towards 2.5% by the end of last year. So way beyond the Bank of England's target, which is why you then actually started seeing them from the previous slide indicate they're likely to start reducing stimulus. So this imported inflation from the pound move is where the Bank of England is quite stuck, because the fact that prices are being pushed up by the currency, but wages and people's living costs, people's ability to spend is not getting moved in the same way. And so they're in a difficult situation of can they hike rates, because the fact that that's going to damage people who have not got a greater earning potential and then don't really want to borrow to fund much more expensive goods caused by the pound move. Now this,
higher interest rates.
Sorry?
And higher interest rates.
And higher interest rates. So they're quite worried about that impact. I think the Bank of England is also quite worried about housing impact. Whilst they never say that they are, I feel that they've had in the past enough chance to raise rates when inflation went back up to sort of 4% in 2014. 2013, I believe. Got back up towards 4%, and they still wouldn't hike rates. And this, I think, was a fear that it would damage the housing market as it was just starting to rebuild itself. However, what you've now got is in effect a bubble in the housing market, higher inflation in the country, and then lower wages. So they're in a difficult situation of what they do, because if they hike rates, if people's wages aren't growing and all of a sudden their mortgages jump up, they could be in a fair bit of trouble. I'll be pleased with it. I'd like to see them hike rates like every month for the rest of the year if it's going to cause a housing crash, but we shall see. Sorry if any of you guys own houses. But yeah, I'd be quite happy with that. Oops, you've gone backwards. All right, next big area that you get a bit of activity is some kind of intervention. This is not all that common in many different currency pairs, but it's whereby you will get a central bank or a government will actually try and influence their influence their exchange rate. You started to see the ECB comment on it. ECB has mentioned that the euro has created an unwarranted tightening in financing conditions. Effectively, the aim is to not use any kind of monetary policy tools to influence the exchange rate. Theoretically, there is an agreement where people will not attempt to influence the exchange rate. However, you do often get verbal communication This is particularly common from the Bank of Japan. They do like to, if they're seeing the yen move in a way that they don't want, suggest that perhaps the yen is getting too strong, perhaps that they could do more to impact the price of the yen in future. So Bank of Japan's probably the most likely for this kind of action. They're the ones that have brought out comments in the past regarding they could change policy to impact the yen. You'll often hear people talking about, Donald Trump actually did it last week, 2 weeks ago, saying that basically he was happy with the strong dollar and he felt the dollar should be strong, which is effectively saying we won't see more dollar strength, and you got a very, very quick move in the pound, in the euro, all as a sell, a lot of dollar strength. The other side of it is pegged exchange rates. Now there's quite a few countries that still have a pegged exchange rate. Generally the exchange rate is pegged to the dollar. And what a central bank tries to do is it uses foreign exchange reserves. It will then use them to either hold a currency above or below a certain peg. So what the Swiss National Bank was doing was effectively they wanted to maintain some weakness in the franc. They would sell Swissy to buy euro to make sure that the euro Swiss stayed at its peg of 120. Everyone knew that really the Swissy should be much, much stronger than this. And so what happened is they then were forced to drop the peg. Anyone know why they dropped the peg, or have a theory as to why they actually dropped it? No. From everything I've read, and this to me makes the most sense as well, the reason for them dropping the peg was the fact that the ECB was about to start QE. They dropped the peg about 3 days before the ECB announced QE. And basically the problem was the euro was going to weaken and weaken and weaken more, which is not what they wanted, because they want effectively a strong euro against the Swissy. And it was effectively they would have had to go against all of the ECB QE to afford to keep that peg, and the Swiss saw that as too much of a risk and too costly to do. So 3 days before they depegged the currency, let it go, and you got that massive, massive, massive drop that we saw. Next question, which does relate to QE, why did equities fall on it? And this is one I must admit I didn't know at the time, which took a little bit of thinking about, and then you go, oh yeah, that does make some sense. It's partly to do with something we talked about yesterday. No. Basically, equities ended up falling because people ended up with massive margin calls on Swiss positions. So as they got huge margin calls, they then sold out of equity positions to fund those margin calls. And people would generally move away from risk assets first before you get anything else. And so you got this very quick, well, it wasn't so quick at the time, there was a slightly confused equity market move, because at the same time, the Swiss dropped the peg, but then they cut interest rates as well to try and mitigate how far the Swiss franc would fall. Didn't do a great job of it. Of course, the Swiss franc still went a long, long way. So initially, you thought, oh, well, this is good for equities because it's a rate cut. So you got to sort of jump around in equities, and then they cottoned onto the move and equities absolutely dumped. What was then there as well, if you thought it through, the reason for the Swissy doing it was then a good reason to buy equities, and equities rallied straight the way back. Pretty sure they recovered the whole move within a day, and they then continued onwards and just continued higher and higher until you got the ECB QE announced the following week. Right, so a quick look at a few of these different examples. Intervention uncertainty. They're the big impacts generally for sort of short-term moves, and this is one from Bank of Japan Deputy Governor at the time, saying yen intervention is still in their toolkit, basically saying they could come in and weaken the yen if they wanted to. They could come in, sell yen, or they could come in and cut interest rates, come in and do something. As soon as you hear that, straight up, yen explodes. This is on a daily chart, and you get sort of a 3-day move higher in the yen just based on those comments. And that's their attempt to actually guide in the currency. You've often had it most of the time with these kind of moves, it will still reverse the move eventually, because the market will then try and call out that bank in a sense, comes back off. Are they actually going to do anything about it? Will they still intervene? And in this case, no, because it came all the way back. The other sense of uncertainty, and this is where everyone started trading the South African rand, was South Africa sacked their finance minister, and then they reinstated him, and then I think he got sacked again. And then Zuma seems to be getting sacked as well, but he still doesn't quite seem to have gone. But as soon as you first got that, you got a pretty hefty move higher in the dollar against the South African rand because of that uncertainty around them sacking the finance minister, what that then meant. It was generally seen at the time that actually the finance minister was someone who was providing a reasonable amount of stability to the country and to the currency. And so the moment that they got rid of him, fair bit of currency weakness in there. And that, brought everyone into starting trading South African rand. All right, this was the Swissy peg drop. What you got was a full 35 point drop, so 3,500 ticks, and I think that lasted about a minute, 2 minutes maybe. I've heard various stories of people actually managing to get on the move, people not managing to get on the move. Everyone seems to have a big story about these kind of things. I remember the day, I remember trading DAX on it because it didn't have Swissy limits and not knowing at all what to do. DAX did sort of a jump up and down in sort of this 80 tick range here. Jump up and down, and then it went. And you were left really confused as to why it was dropping so fast. But this move here, 99.50 right the way down to 96.50, so you got 300 ticks in 3 minutes. It was bonkers, and at that point virtually everything in the book just pulled, so you just end up with like a one lot sort of about 20-30 ticks apart, and then they disappear, and then you'd see an offer come onto your screen, then you see a bid come onto your screen. It was tradable just about, but you had to sort of throw a bid and an offer and wait and see if you got hit on them. So you could quite quickly take a 50 tick winner followed by a 40 tick loser followed by a 50 tick winner. And so by the end of it, I felt like I'd probably taken on a huge amount of risk and I'd made about 80 ticks, which was reasonable result, but the risk taken to do that I think was perhaps a bit excessive. But as I say, it turned around, and this was within the day. In fact, it was within the hour that you got all the way back. So that quick realization of what it meant gave you actually a huge buying opportunity down here, but even if you sort of spent 45 minutes to 25 minutes to think about it, you had the wedge to go back the other way. And as I say, this then just kept on going. So DAX is trading just below 10,000 here. By the time the ECB did QE, I think it was trading 11,000. So it did another 1,000 ticks before the ECB meeting the following week. The only other real example of this was China devaluing their currency. So they devalued the yuan. Yuan's semi-pegged against the dollar. Yuan has a strange.
So can I ask a question about the Swiss peg?
Yeah.
So let's say if you don't have a stop loss and you are long, then you are completely screwed, right? And
On this?
You are just before this happening.
Yeah.
So,
If you don't have a stop, yeah.
and even if you have a stop, there is such a big slippage that
That's the problem, and that's what people were surprised about, that they lost money. Because the fact that what the trade was prior to this was basically you have a bid at 120, every time it goes down there you get hit, you know the peg's there, and then the market comes back up and everyone puts their stop just below. But because every single person has their stop at 119.90, they all get hit together. There is no bid, because why would you bid below the peg? You're never going to get filled. And so there is nothing for your stop to sell to. And so because everyone's got a stop market, and this is where a stop market, not a limit, can have an impact, all the stops go off down here because that's the only place anyone's got a bid. And that's the problem, because they can.
this is kind of like a black swan event, right?
It's a massive black swan event, I think. Yeah, you can't ever necessarily see it coming, but this is something that you could be thinking about as a possibility. That the possibility is always there. And actually after that, we then all started thinking about what other currencies could drop their peg. So a few of us, me, Wakas and Demetrius, ended up putting on Danish kroner positions, because the fact that's pegged to the euro. So the idea was, if the Swiss drop it, maybe the Danes will be pushed into a similar situation and drop their peg. So the idea was you get a kroner position, do it in cash, because the fact that you don't, the day-to-day movement could still be reasonably costly in futures. Do it in cash, knowing that you're probably going to make 20% on it. So you can do, say, 50 or 100 grand. If they drop it, you've got no fluctuation throughout the day, and then they drop it and you make 20%. It never happened. I think we all sat on the position for about 18 months. Nothing happened, and it was like, it's not really working, is it? It's not really going to do anything. And the Danes have still got their pegs, so I'm glad I don't have that position anymore. But it is a total black swan, but it could happen.
And going back to using this as a black swan example, and the approach to using the ladder without a stop in the book.
Yeah.
For me, it feels a bit it feels risky. So usually when it's sim, usually I was using OCOs.
Okay.
And when I was entering the position, I always had like a stop like 20 ticks below my entry.
Mm-hmm.
And even I usually was then moving it, but it was there just in case something is happening, right?
Yeah.
And I do you think that's of course there is also some disadvantages of this approach as well, because you can be actually stopped out by these 20 kicks and then it will reverse.
Yeah.
But I don't know, it just gives you some kind of feel that safety feel in case of this kind of black swan event.
True, but the safety that you've got on this event wouldn't have helped you.
Yeah, exactly.
So in fact, the safety would probably actually have been worse.
Right.
The other problem with using an OCO on something like this is ultimately you want to sell it, and if you were fast enough on the news, you could have sold it. But if you put an OCO in, it would go hit your target, and you take your 20 tick winner, and then you watch it go 3,500 ticks, and you're like, damn, that's
Now, assuming you are long, right?
Yeah.
Before it's happened.
Yeah.
And you're kind of in the middle of the position and it happens, and then you're long, right? And then you need to get out, and there is no one.
If you have an OCO there, you're going to have the same problem. But with
a market stop. Yeah, exactly.
Yeah, and with the stop, it will get you out somewhere. Whereas, yeah, potentially at the bottom. Whereas if you're long, and as horrible as it would seem, you're better off to buy it down here than you are to stop out down there. Because at the end of the day, if you get out down there, you've definitely lost. If you buy it on this spike down, it could have gone too far, and you might get yourself at least back to some kind of scratch, or not such a big loser. It's a very, very brave trade to do. I wouldn't necessarily recommend that it's the right thing to do in all situations. But really, the wrong part of that trade is being long up there. Because it's pegged, there's never any reason to buy Swissy, because you know that, or sorry, to be short Swissy in the really. There's never a reason to be short the Swiss. So because this is Swiss strength, you're effectively short Swiss if you're long up there. There's no reason to ever be short the Swiss, because of the fact that fundamentally it should be stronger, and so therefore fundamentals are saying you shouldn't do it.
I mean, yeah,
There's a
you
peg.
have some technical setup, right?
But that's the thing, there was virtually no technical
It's
setup,
just the
because
last thing.
yeah, if you took this back, that would be the line,
Okay.
and the market would just go like that, and occasionally it would go like up like that.
Right.
So your risk was you're buying this, hoping to get out for your 20 ticks when it does the little spike up, and your risk is 3,500 ticks. Now, don't get me wrong, I don't think anyone could necessarily said if the peg goes, it will go that far, and it went that far because of people getting out of positions. So, you know, you look at where it bounced back to, and it bounces back to 1. So these final 15 points of move was just total overextension. People were just getting too emotional, ultimately, and forced out. You know, there's going to come a point where people just have to get out. You know, get their margin call, and the only way to cover the margin is to sell the position. So, yeah, that's basically what happened. It was a pretty crazy move. But yeah, these Black Swan events, they do happen. What I would say is it's not a reason to not take risk on, in the sense that you can buy a level and the market goes through the level and hits a big stop below the level and puts you way further offside than you would normally be comfortable with. And even if you've got a stop, it will probably give you slippage. Yes, this will happen occasionally. Yes, it's not a nice feeling. But for every trade that you don't take because of the risk of that, you're probably going to make more money on those trades compared to the one that actually does get you. And yeah, like I say, it's not nice if you get caught on something like that. S&P's just opened. And it's looking still pretty crazy, which is good to see. I'll be interested today, if you watch it, if it does similar to yesterday. So this is what we got yesterday. We dropped, moved back up. As soon as we went back through the open, that was where we exploded higher from.
It's thin, right? As well.
It's very, very thin still. Let's get 1 minute up. So yeah, that's, now we're getting back up towards the opening price. See if we can buy it for the open. A little bit less
What was the
willingness.
open about? 88.
87s, 88s. No, decided not a repeat of yesterday, unfortunately. And we're going back down. So that was not ideal. But yeah, no repeat of yesterday. not just yet at least. We'll go back and have a quick look at what we did yesterday on the open. You can see whether there might be another chance of it as well. Yeah, so we got a dip for the first minute, and then it was once we got back above, then we really started to go. But we're 2 minutes in now. We're still struggling. I still think if we get back through that open, we could still be on for a little bit more movement. There you go. Oh, we got 1,000 on the bid now. Tested yesterday's close. See that little jump then? That would have been that 1,000. He just decided no, he's just going to have them all in one go. Still, market doesn't quite know what it wants to do. I think it's going to be a little wait and see on that. Back up again. And maybe it's now actually more that break through the 98 area that you're going to have to be looking for. So if we get something that sets up a break there, you get a little pattern where the market holds just below 98s, you get in on that through 98 and then look for that move higher. If we do go higher, the fact that we've so far, the peak of this move is yesterday's close, and we've not managed to go any further beyond that, perhaps that is it. Perhaps we're going to see a little bit of pullback now. But we are back up above 81s. We are sort of beginning to push higher, so we shall see. Right. That chart stayed on the top. That's not ideal. Let's get rid of that. Okie doke. Talking about China devaluing their currency. Like I said, China's a little bit odd in the fact that they have a currency that's pegged to the dollar but is also semi-free floating. So the Chinese actually fix it by using their monetary policy effectively to fix it within a band. You also have an onshore and an offshore yuan as well that generally trade in the same ranges. One has the fix to it whereby they will peg it to the dollar. The other one basically follows. And this is then what happened. So another question on this one, China devalues. Why did equities drop on this one? Because it was less of a peg situation, so you wouldn't have had people sitting on the other side of the peg that was suddenly going to get margin called. There's a bit more of a fundamental reason, this one.
Stronger dollar.
Going in the right direction. Basically, yeah, the idea that with a weaker yuan, China is a big importer of US products, particularly things like cars. So this again particularly hurt the DAX as well, because Chinese imports of German cars are pretty big. China's probably the biggest buyer of German cars outside of Europe and the US. So it had a major impact because the yuan gets weaker, their buying power goes down significantly, and therefore demand for other countries' produce drops quite a bit. That's why you've got major S&P fall. This is on a 1 minute chart sorry, no, it's a 5-minute chart. On the 2 days when they devalued, so devalued once again, and you get the S&P drops from 2035 right the way down just to 1800. So not a dissimilar to move to what we got the last couple of days. And that actually down there did hit the limit down, unlike we got on the last couple of days.
Can you have limit down on currencies then?
No, I don't think you necessarily get a... Actually, no, it's CME, so there is a limit, yes. And what you get is, you will see that there's a limit, but it's not quite the same as the strict limit down. It's a bit more like the Eurex volatility stop.
Yeah.
So what happens is you will just see it will go bid and offered at the same price and sit there, and then it will start to trade again. So not quite so much of a limit as such. Oh, the S&P is going for it now. Just had that early messing around. I think what we need now is a little bit of a hold up here somewhere. Give yourself an opportunity to get in. To be in for that break. There we go, 98's hit.
So from here you wait for it to pull back to like 96s or something?
Yeah, I'm wondering that now. Because it's not sort of exploded for it, but you consistently you're seeing it them come on straight onto the bid, straight onto the bid, straight onto the bid. But from yesterday, what we do know is every time it did come back to these kind of things, the pullbacks were sometimes quite vicious. You get one really, really fast pullback.
I came out of that way too early.
Oh, you managed to get long?
Yeah, I was on the break about 90s.
Oh, you got long 90s. Very nice. The housing comes on the bid and they don't run away from it. I'd watch that 900 now. If it trades through it and then comes straight back on the bid, this could be a bit of an opportunity. Dropping back towards those 98s. Yeah, sorry guys, just a little bit of interest for you guys just here on these breaks of 98. See if we are going to get a bit of continuation.
96s.
Yeah, it's 96. You got a little nice little drop of volume just down there. That real quick move might have been a little sort of fake flush out. Everyone's paying for it. I'd like to think you should see a little bit more. Pace in this move now.
Whoa.
Yeah, everything possibly up as far as 10s on this move. Difficulty is going to be how far it pulls back before it does it.
Do you base 10s on just the size of the move already?
10s on the basis that you've got single prints fill in at 10.5 just up there. So that'd be the area I'd be looking for. I mean, now it's sitting just above like 3s, and you've got a little dip in volume just below down here. So if we do see a bit of a pullback, I've actually got out because basically I was not too keen on seeing it come too far back, which is perhaps the wrong thing to do. But what we saw again at 96 is you saw that very quick whip back down to this little low volume area. So I would wonder if we drop back down there quite quick. See that? Very similar type move. But not the same reaction. Ah ha ha. A lot of people frustrated with that one. Yeah, as soon as that 02s, 01s, now perhaps becoming a little area.
Low value here.
Yeah. Oh. Wow, all the way back. Too slow. The order didn't go in quick enough. That was the one, back to 98s. This is where long's going to start to panic if it does start dropping much from here though. It's a lesson I learned from yesterday as well. You really don't want to do too much size because the speed it goes wrong. A day like today is pretty dangerous. Yeah, you see how it just really doesn't want to get over double O's at the minute. Every time you get up there, you get this little punch up and then it struggles. Could still be on, that could still be sort of the low of the pullback, and then we're going to keep going.
What, 98s?
Yeah, so it keeps dropping sort of 97s area, and then it's struggling at double O's. So if you get a break over here, that could be it. That was the kind of thing you'd see yesterday. You'd start feeling confident once it got over 01.5 then. And then it just whips it straight the way back. Yeah, I think perhaps it's going to take a little bit of time. Is that it? You don't get, as soon as it gets to 01.5, you just don't get any more buying up here. It just slows down completely and it starts dropping back, and then back it comes again. So I think now it's just taking a little bit of time to work out whether it wants to actually go, or whether everyone who got in on this move, or any shorts that got pushed out on this move, whether that's it. And if it starts getting back below 98, that could then end up being the end of the move, and we're just going to go 98s and then reverse back into the range. Still back down 97, 98 and a halves. I think this is this is now becoming a bit of a tricky point. If you really believe in the trade, you can still buy it here, and perhaps you put your stops back down towards 95s. What you've also got is this 20 period moving average coming in. That's something generally on a very trending move in the S&P, I think would often hold it. Although yesterday, it was doing that every time it got to it. If you bought or sold on the moving average, it just went bang straight the way through it. So it put you in a fair bit of bother, at least, if you did have a go at buying it. So it does seem that little breakout perhaps was a bit short-lived. It might well do it a little bit later on, but it might. Yeah, I think it's going to need a little bit more time to actually have sort of a proper build-up of a bit of structure before really going for it, if it is going to. But yeah, keep your eyes on it. Yeah, once again, you dropped back to that moving average, and it won't quite do it one way or another. Right, should probably get back to the job at hand, and then let you guys go and trade this, because again, this is all quite exciting, and I think that you're going to learn a lot from having a go at trading this as much as you will from a bit of fundamentals on currencies. So we'll move on quite quick. Knowing your country makes a big difference in terms of fiscal policy, elections, and also what makes that country tick, if you will. So we're going to have a look at sort of economic concentration in a bit. Certain currencies are so tied to certain commodities that they almost become a proxy market for that commodity. Thinking particularly, we'll use the example of New Zealand. 33% of the world's milk comes out of New Zealand, despite being a very small country. So the majority of their economy is entirely based on milk. So New Zealand dollar is extremely well based on that. Fiscal policy to start with, government spending and taxation. This is perhaps attributed to why we got the S&P so high recently, based on Trump's tax cuts. And it was almost a promise of that, and you can always attribute things in hindsight, but you look at the promise of the tax cuts, as soon as that actually got done, the S&P continued up for the beginning of this year until those tax cuts were done, and then it really started to drop. So you could almost say it's a bit of a buy the rumour, sell the fact type move. Also, increased government spending. This increases national debt, which therefore decreases the credit rating of a country, so less demand to actually own that country's currency. Lower taxes as well, going to make firms more competitive, so greater earnings. Generally, you will then want to see a flow into that country to buy US stocks, or whichever country's stocks that is, which is a difficulty with Europe, because if you only have the euro and you've got lower taxes in Germany helping German firms, yet you still don't get quite the demand for their goods if inflation is moving based on other countries in the euro, for example. Economic concentration, again, this is the point on different commodities. Main examples of this really are Canada and New Zealand with oil and milk. Other one, South Africa and gold is quite a big one. I don't think you'd really be able to argue something like Colombia and coffee necessarily. Colombia also may be pegged to the dollar anyway, so not such an impact. I would have said Saudi Arabia, but again, they're entirely pegged to the dollar as well. So there's a lot of the very economically concentrated on a certain commodity countries are predominantly pegged to the dollar. Canada and New Zealand, little exceptions. So nice example of New Zealand dollar versus monthly milk prices. Steep drop in milk prices throughout 2014, steep drop in New Zealand dollar throughout 2014, and consolidation in both of them. You get a fortnightly milk auction from New Zealand, the GTD milk auction, and if you want to trade it, you would trade it in the New Zealand dollar, not in milk futures, because they are exceptionally thin. Trade very, very little on a day-to-day basis, so you can actually trade the milk auction in the New Zealand dollar if you did wish to. I don't think anyone does, but it is a trade that people can take on. Similar kind of thing with Canada. You can't necessarily trade the oil numbers in the Canadian dollar, but a general sense of what oil was doing is either positive or negative for the CAD. So oil prices currently rising, generally will be seen as reasonably good news for the CAD. Right, elections, that's the other massive impact on currency. This is the euro on the US election and what started to happen. So initially you ended up with major dollar weakness because the fact it was seeming that Trump's coming in, which then turned to dollar strength. Once again, that flip of one, safety, if there was fear about Trump's policies, but also there was a lot of demand for dollar because of the fact that he was promising to cut taxes, he was promising to repatriate a lot of US earnings. So you would then have a lot of earnings coming back into the US, which would then be pushed into improving the US economy, therefore creating demand for dollar. And it's exactly what you got. You got this very quick spike up, and then we got a drop for the rest of the year going into the end of 2016. So that was the first one in terms of elections. Really, really big move. A lot of people traded peso on that. The other thing that a lot of people thought of trading, the reason for trading pesos, because obviously it's bad news for Mexico. The big outlier trade that was perhaps the one that was going to move the most on Trump victory was peso yen, because the fact that the peso, it would be bad for the peso, you then get a risk play into the yen as well. However, how tradable that was, I'm not quite so sure. Peso, in fact, if you look at a ladder, 6M, is actually pretty thick. In fact, there's probably more on a bid and offer than you would get in the euro. So, yeah, peso is entirely tradable, particularly if you've got any comments based on US elections. But yeah, peso yen was the one that people were talking about trading, but I don't think it was all that tradable. Personally, I trade S&P on it just because to me that made a little bit more sense. It was a little bit more clear cut, whereas with the currencies you ended up with dollar weakness followed by dollar strength. The S&P was bad news, and that was it pretty much. It did reverse the next day. You had a very, very large bounce from the limit down, and then it just got bought straight off the open, straight up. 100 handles, I think, something like that, US election. Again, I think that's perhaps because of the realisation of the tax implication. And whilst people don't like Trump and don't necessarily like him as a character, doesn't necessarily mean that he's going to be bad for companies in the US going forward. I think that was perhaps the reason why you got that turnaround. Okie doke. The other one is the impact of currencies against equities, and why you got that massive rally in the FTSE post Brexit. And all this was down to was the fact that the weakness in the pound ended up being good for FTSE companies. All their earnings are not in pounds. So they've all effectively just got a 20% bump in earnings on that. Again, once thought through, this actually meant that the next day after Brexit was actually a fantastic buy for the FTSE. If you compare the FTSE 100 with the FTSE 250, which are more domestic companies, the performance is way, way different. FTSE 250 pretty much flat since Brexit. FTSE 100, where the majority of companies are multinational, they have earnings in dollars, in all sorts of other currencies, all performed massively well after it. That's where you saw outperformance in the pound. Outperformance in the FTSE, which is trading down at 5,500. FTSE is now trading at just over 7,000. It was up to 7.5 last week. So Brexit's been good for non-UK companies that are listed in the UK, basically. And that's the lot on currencies. Anything else anyone wanted to know on currencies that you really need to be sort of focusing on? I think I've pretty much covered everything really there. So any questions, any areas that you're unsure of that you want me to go over, I think will probably all come up in due course anyway when we do monetary policy, when we do various other elements of the course. So yeah, if there's no questions, I will let you guys continue trading on the US session, which is looking quite exciting. It's back up, I see.
Yeah, DAX making new highs.
Yeah, is this the big turnaround now? Yeah, DAX making new highs now. A little grind back, but yeah, if you bought it on that move back to 87. Oh no, sorry, you needed to get back above 87, and then it held it once again.
Keep fucking up my execution.
It's really tricky in this environment.
Well, no, I keep like adding to. I was like trying to take some off at the high there on the DAX and adding to it instead.
Oh right,
So
so you're
annoying.
doing the wrong thing.
Yeah.
That is frustrating. Yeah, I hate it when you do that. It does happen occasionally. What I don't like is when you say you're in a position, you press 1 to get out, to click 1 in, you then don't click anything, you press 1 again, and you then get 11 when you really didn't want 11. Or you'll say long 5, you go to get 1 out, and the next click you get 11 out, and now you're 6 short, just where you only really wanted to get 1 out just to cover a little bit. So yeah, it does happen. It's extremely frustrating because not only are you right, you're now right and getting punished for being right for your own stupidity. It's extremely frustrating. All right, Paul. We'll wrap it up there. Any questions, do ping it on the group for those.